Hey folks, how's it going? Looks like the market is about to close here in just a moment. And yeah, so let's talk about some earnings things today. And I wanted to address a question that somebody got in really early, largely because it just brings up a whole can of beans here in terms. And the person who brought this up is not from the United States, and I assume that English is not their native language. When you say you're opening up a whole can of beans, it means that it's going to lead to unanticipated questions and problems and issues and things like this. So the question is yesterday we touched on the subject of flying cars. How do you think traffic will look in the future when personal flying cars will be available to larger groups of people? Okay, so that's actually on the surface. It's actually a much larger and deeper question than it may appear on the surface. And I had this discussion a number of years ago with a fishing buddy of mine who happens to be a fairly large property developer here in San Diego. We used to have boats parked right next to each other before I sold mine, of course. And, I've gone out fishing with him a number of times over the years, and we discussed kind of the future of retail properties, office properties, traffic, and that sort of thing. This actually comes up quite frequently. And he and I kind of planned this thing out like 4 or 5 years ago, that we think that the nature of car ownership and vehicle ownership is probably changing, that there's going to be a generational change. Gen Z will probably just not own vehicles quite with the same frequency that previous generations did, and that I'm not sure that flying cars will make all that much of an impact on traffic, because I think that the larger impact on traffic will be the lack of car ownership and people using rideshare services, whether that's automated rideshare services or just saying, hey, I don't want to pay. Number one, I work from home a couple of, most of the time. I walk to the grocery store, I walk to the gym or whatever. I only need a car 2 or 3 times a week. They're going to be taking rideshare services, and they may even be taking rideshare services with other people as well. That might decrease traffic in the future. Now, I don't think we've seen that yet at this point, but I'm thinking that the very nature of car ownership may be changing. And the idea that he and I kind of envision is that in the future, people wouldn't necessarily own cars. What they would have is subscriptions to car companies. Like you might, or it may not even be like that. It may be subscription to a service like Uber, where you pay a flat monthly fee and you're able to use it a certain amount of times per month or whatever it is. But a lot of those cars will probably be self-driving, and at nighttime, during the day, they're traveling around that two-dimensional space on flat ground, possibly delivering you to three-dimensional office space downtown somewhere. But more likely, they're only doing that a couple of days a week because you're off working, from home a lot of times. So this is my struggle with flying cars, and this is why the suggestion that Mark made yesterday with investing in an EV company that's going into that EV vertical takeoff and landing space as well might be a really good way to get exposure to flying cars with a lot less risk, meaning that XPeng already has like real sales in cars, a real pathway to profitability, and their foray or entry into flying cars, they're pretty ahead of their competition right now, especially in terms of software. So there's a lot to unpack with that statement when personal flying cars are going to be available. We're looking at a practicality issue here. I've talked about a few things, like the noise when you live next to someone who has a flying car. Do I really want that? Is there going to be increased regulation on that? The FAA regulation in other countries as far as personal ownership of flying cars. How do you manage traffic? These are all questions that are going to arise in the future that we don't have answers for yet. So I think that's one of the more interesting questions that somebody's asked about future technologies in the last couple of weeks. And I'm getting a call right here. In the last couple of weeks. And I think that I should dive more into that, maybe make a video on that, talking about all the different ways that could go. So, yeah. All right. So on to, the next comment here. Let me see here. Most a gear. I don't know if I'm pronouncing your name correctly. How bad will the market get as the S&P going to 3,400? So I don't know how low the S&P is going. I kind of had the S&P at 3,800 as a floor, and pretty much as a support level. I think we're going to bounce around 3,800 for months to come. I don't think we're out of this by any means. So we technically haven't actually hit bear market territory yet. And I think a lot of people don't realize that. In fact, Barron's put up a fancy little chart here. Let me see if I can find this real quickly. Yeah, so let's see if you guys can see this. So this chart over here, basically days from peak to trough from the S&P 500 that I'm circling over here, it goes through your average is somewhere right on here, just short of 300 days, so like 280 days or so. Technically, 2022, we are not even in bear market territory yet, which is the sort of very definition of bear market territory, which is I want to say that you're down 20% for the peak in 6 months or something is the technical definition of it. So we haven't quite hit it yet. And but I do think that we are looking at a longer bear market here. I don't think you should jump into the market right away with everything you have. I think dollar cost averaging is always a good strategy. It's really a good strategy right now. There are a few stocks I wish I would have had the money to jump back into. I checked SoFi this morning, and it's up pretty big in the last couple of days. Another one that I picked up. Another one that I picked up. I just can't think of the name right now, is up pretty big as well. Upstart was the other one that I picked up. They're up pretty big. I picked them up at $26, $27 a share, and it's at 51, 58, and that's only after a couple of days. I only got 10 shares. If I had gotten more, I'd certainly be happier, but I'm happy to have what I have at that price. I'll be looking a little bit later to add, and I think there's going to be more volatility and more opportunity to get in there. So, yeah, so excited for XPeng and Neo earnings in a few days. I hope they get back up 100% from here in the next 6 to 12 months. So in the next 12 months, I think it's entirely possible that Neo and XPeng go back up 100%. I think it would be completely reasonable, right? What I don't expect to happen is for Neo and XPeng to have reasonably good earnings for this quarter, or for this quarter. I think it's going to look okay, but you're really looking at monthly delivery numbers coming out kind of right around the same time for April and for May, and it's not, or for April rather, and it's not going to look good, right? Shanghai has been largely shut. This is a city, I think, of 35, 40 million people, has been largely shut down off and on for the last 7 weeks. Even Tesla's only been running one shift on a closed loop at their factory. So we're looking at production is going to be way down. Sales in Shanghai for the month of April were 0 auto sales for the month of April. So this is not looking good, right? It doesn't, and it may actually provide opportunity for you to get into these stocks if you were looking to get into these stocks. So at this point, I'm not down on Neo yet, but I am underwater on XPeng, just barely. But I got Neo at virtually nothing. Yeah, so XPeng has an interesting flying car development, is way ahead of many companies. I agree with you when it comes to that assessment. So, and dimoes says parking is way too expensive in cities, 2 to 3 times the cost of a car. So, I've never actually lived in the center of like a really, really big city. And I've always been one of those guys that's like, I'll park far away and take the bus in or something if I have to go into downtown. And I've telecommuted as much as possible, since it's been possible. In fact, I did some of the earliest telecommuting that you could think of way back in like 1998, 1999. When I worked in the IT industry, and now almost 100% of my business in the financial sector, at least, is remote. So, yeah, I don't pay for parking like a lot of folks do, but I do understand that, like, when I went to university, the parking that I had to pay in for my second degree was almost as much. It was like 2/3 the cost of actual tuition to park on campus. It was absolutely unbelievable what parking cost. And unlike a lot of the students there, I lived far enough away to where I didn't really have a choice when it came to like taking a car. I had to. But I managed to actually rent a parking space from someone in the neighborhood nearby and then walk. So it was kind of interesting. But anyway, that's a story that's not really relevant. I'm going to go over some earnings here in a little bit as well. Hi, Jason. What are your views about the metaverse and the commercial benefits for Facebook? Thanks. So I did a video on the metaverse about a year ago at this point, and it's actually, I think at this point it is my best performing video out there. We did it about 6 months before the metaverse became a real topic, and then it got found on search results, and that became one of my most popular videos. And I went over kind of like the basic possibilities in that, and I gave in the description kind of a list of companies that are involved in metaverse technologies. And that list of technology or of companies has actually changed quite a bit since that original video came out. So I am not convinced that Facebook finds a way to get into the metaverse in a meaningful way and to monetize, the manner in which they get into that. And there's not going to be a single metaverse. Of course, there's going to be multiple metaverses. I don't know if you guys have ever seen the Ready Player One, and I assume that most of you have. And if you look at sort of a future version of the metaverse where many people are interacting in this virtual world, in that world, you had a single company that managed to dominate this space, whereas in reality, you're going to have multiple metaverses. Like I clearly envision that at some point there's going to be a Roblox metaverse, at least based on their engine. There's probably going to be one for Unity, and there's probably going to be one based on the Unreal Engine from Epic Games. Now, how that evolves is anyone's guess at this point. And I do think that Unity Software, which has their own like 3D engine, I think it's a worthwhile investment to look at. I did a video about a year ago. It's probably outdated now. I want to say when I did the video, the stocks was like $77 a share. I'm underwater on this stock as well, but this is another stock that I am adding to little by little every chance I get. And my time horizon on this is pretty long, though. I realize that it may take a very, very long time in order to find a way to a satisfactory return with a stock like this. So I wanted to take a moment here to give you guys a heads up on some very serious things that are happening in the world right now and how you can invest and get ahead of the curve on this. And I want to take a look at, I went to just rolling around Wall Street Bets, and this is Wall Street Bets new. And it probably comes as no surprise that the Black Sea Fleet of Russia is blockading the only port that Ukraine still controls now, and that's Odessa, which they probably would have used to ship a lot of the grain out. And they're also stealing a lot of grain, and they've refused to ship fertilizer overseas. And so let's talk about that for a moment. And let's see if I lost my track here. So food security is national security. India is now halting wheat and fertilizer. It's already doubled since 2021. We see American fertilizer stocks reach new highs. I'm going to go over some of those fertilizer stocks as well. Elevated fertilizer prices remain as UNN talks to restore Ukrainian grain exports. They can still export grain. It just is going to have to go through Poland or something like that, and through one of the ports there. It's going to add expense to it. It's not going to do a lot to alleviate food security concerns. But if you notice, food security concerns are coming up quite a bit in this investor forum. And I realize this is not a perfect gauge of investor sentiment, but I think it's kind of largely missing the point, is that we have not even begun to see because the harvest should have been planted, last month and this month. We won't even see the harvest until beginning July, September, October. And that's when we're going to see prices really become effective. Like there actually isn't a need. I don't know what you guys know about growing, but you don't fertilize the ground until after the seedlings are kind of established, because you don't want to shock the soil or anything. Because when you use too many nitrates, you can end up it can end up overwhelming like really young plants. So we're not even in line for the first round of fertilizer that we need for a lot of parts of the world where they have actual seasons. Not here in California. We don't have any seasons. You can plant almost anything all year round. But in a lot of places, we haven't even hit the need for that first round of fertilizer, right? So that is coming. So let's talk a little bit about a couple of fertilizer stocks. And this is an article from Investor Place. It was actually put out, I think, just a couple of weeks ago. Yeah, April 13th, 2022. And so there's just a couple of ideas to look at. So Nutrien is a potash production giant. Potash is just one of the ingredients that goes into making nitrate-based fertilizers. And ICL is an undisputed leader in productive trading under 2.5 times sales. CF Industries, there we go. Yara International, outstanding fundamentals with a great yield. But these are all companies that are involved in fertilizers. All right. So I'll post this article right here in the actual comment section here, so you guys can see this link if you want to come back and take a look at it. And I'll post it afterwards into the description, right? But Intrepid Potash in particular is probably a very good place to look. Now, this is a cyclical stock, meaning that you'd probably want to. This is not something I would buy and hold forever, or I'd at least have an option writing strategy on it for a cyclical stock. That's one of the ways that people make money on cyclical stocks is they either pay a dividend or you have an option writing strategy for when the price starts to go into decline. Okay. And and this is a cyclical industry. You're going to see ups and downs based on seasonality and profitability. And so the other thing let's cover also is that agriculture here in the US is going to change, right? We have enormous amounts of land here that is not being exploited. There are a number of different ways to invest in farmland now. In fact, there is, let me see if this is, let me pull this up real fast right here. A number of different ways to invest in farmland through a real estate investment trust, right? And that may be something that you haven't really considered before. So this is, let me see if I can get this to pop up here. This is the Gladstone Land Corporation. If you see right here, their fundamentals look pretty good in terms of their earnings. They've had growing revenues. They are a profitable company, but this is a real estate investment trust there by nature. They're profitable. Gladstone Land is a publicly traded real estate investment trust that acquires and owns farmland and farm-related properties located in major agricultural markets in the U.S. and leases its properties to unrelated third parties and farmers. Something like 60% of all farmland is actually leased farmland, where the owner leases on a triple net basis to a farmer, and the farmer does all the improvements, farms the land, and just pays a flat fee. So a number of really, really wealthy investors over the last 2 or 3 years have been pouring money into farmland. This is one of the ways you can do that without having billions and billions of dollars. There are a couple of others of these these REITs, these real estate investment trusts that focus on farmland. So if you look, the forward dividend yield is 2.11%. That's not a great forward dividend yield, but you're looking at a combination of capital appreciation and dividend yield, which is going to give you your overall return. And if we look at this over the last 5 years, it looks pretty good until you hit April 1st of 2022. And this is just general market disruption. So I think this represents possibly a fairly good buying opportunity, particularly when you consider that owning farmland is probably one of the best ways to keep up with inflation over time if we see persistent higher inflation. So I can tell you, like, if you go to any of the major financial planning software companies right now and you run a financial plan, they are not estimating that that inflation is going to be that elevated over time. They are right now, the default estimation is somewhere between 2.34% and 2.44%. We have a lot of folks actually requesting that we run illustrations with inflation numbers that are quite a bit higher than that. Realistically, though, look, we have 8% inflation right now, but over time, over a 5, 10, 15, 30-year period, if inflation were to be over time at roughly 4%, that's a disaster. Okay. So inflation should be somewhere between 2 and 3% over that extended time period. And if you're looking at farmland, I think that I think this represents something that could be a pretty good investment. So not a recommendation to buy, sell, or hold this particular stock in general. But yeah, this is something you may want to check out. And I saw this article a couple of days ago. It mentions all of these others at the top right here. LAND, LANDM, Lando, FPI, and all of these are REITs that are traded just in farmland. So Gladstone Land Trust is one of the best pure plays, though, and there are a couple of other options listed in there. Farmland Partners Inc. is another one focused on agricultural land across the U.S. So cyclically investing here in fertilizer companies might not be a bad idea, and taking a more long-term approach to a farmland real estate investment trust. Also taking a long-term approach to an apartment-based real estate investment trust is going to be pretty good as well, as there's going to be tons of pressure for rents to at least stay pretty high were to get even higher, right? The affordability index for homes is actually rising and or is actually crashing right now, meaning fewer and fewer people can afford to buy homes simply because interest rates have gone up, which means that there's actually zero pressure on folks who rent properties out to keep rents low right now because they know you can't buy a home, right? And so, yeah, that's one of the things that's going on. So real estate investment trusts focused on residential, something like Avalon Bay. I think AVB is Avalon Bay Communities is an apartment community. And this is, once again, folks, not a recommendation for you to run out and buy this particular stock. But this is this pays a 3% distribution going forward. So if you don't know, real estate investment trust is not supposed to have a ton of way in the way of earnings per share. You're supposed to distribute something like 90% of what they bring in back out to the shareholder. That's the structure of the real estate investment trust. That's how it works. So you have to distribute 90% of your earnings in order to keep that corporate structure. And then you have about 10% left to reinvest. So when it comes to like reinvesting in properties, they have to go out and raise money with additional offerings to acquire new properties, or they make money with through buying and selling their other properties. So dilution is always a little bit of a worry with these companies. I think it's completely unfounded worry. It's simply a part of their operations. But you want to be very, very careful when it comes to real estate investment trusts. A lot of these companies don't actually hold tons of physical buildings. Some of them hold lots of mortgage debt. Even after 2008, some of them have just tons of mortgage debt. So, yeah, this is not one of the best things if they have a bunch of mortgage debt and we're seeing interest rates rise. So make sure when you're looking through there, you do your due diligence and you make sure that these companies are holding a lot in the way of actual. So let me see here. Do we have any updates on Chinese ADR delisting? If not, when do you expect an update? We don't have a ton of updates on this right now, and I think it's going to come down to the wire before we have a deal. This is just the way negotiating with China works: is that everything ends up down to the wire. So, I think that's one of the most frustrating things about owning Chinese ADRs. And it was a couple of companies recently called, investing in China uninvestable. And now they've turned around and made recommendations, right, to buy these Chinese stocks just like a month and a half later. I think it's pretty wild. So let's take a look at earnings that came out this week, and let's talk about the good and the bad. We talked very briefly about Target's earnings earlier this week, where we talked about comparable sales grew, and this is just their press release from here, so we can get the gist of it and not go through the whole thing. But comparable sales grew 3.3% on top of 22.9% growth last year. All right, that's an indication of great growth, right? Comparable sales reflected in traffic growth of 3.9%. Store comparable sales increased 3.4% on top of the 18.4% growth last year. Digital sales grew by 3.2%, following growth of 50.2% last year. Same day services like order pickup, drive up, and shipped grew 8% this year, led by drive up, which grew in the mid-teens on top of more than 120% last year. And that was a lot driven by the pandemic, of course. Up more than 95% of Target's first quarter sales were fulfilled by its stores, right? And that's usually through drive up or by going there. So sales growth was led by less frequently purchased categories, including food and beverage, beauty, and household essentials. And I don't know this for a fact, but I would bet that was actually being driven by drive up, that people are ordering which is something they didn't necessarily do before, but they're ordering their food, beverage, beauty, and household essentials from drive up or from delivery. So operating margin rate of 5.3% was well below expectations, driven primarily by gross margin pressure, reflecting actions to reduce excess inventory, meaning sales, as well as higher freight and transportation costs. And let's be honest, higher labor costs had to be in there as well, right? That had to be one of the big deals in there. So fiscal 2022 guidance, and this is one of the things that probably really hurt their stock and caused a big drop. For second quarter of 2022, the company expects operating income margin rate will be in a wide range centered around first quarter's operating margin rate of 5.3%. this is the disappointment, right? They're not expecting improvement in margin here in this case. So I don't own any individual Target stock in this case, but I do see, and I haven't looked at it since it dropped really big, but this honestly, if I were looking for an opportunity to buy, that would have been the opportunity to buy. This was an overreaction to news that was negative, but not all that negative. This company deals mostly in consumer staples, not in a ton of discretionary shopping. When you go to Target, it's generally for things that you need and not necessarily things that you want. And their operations, they are affected by downturns in the economy, but they're not greatly affected by downturns in the economy, right? So, yes, so I think this is interesting. And let's take a look now at Home Depot's earnings, which Home Depot is a bit of an anomaly. They do well, really well in times of downturn, which is kind of surprising. You would think that people aren't thinking about doing home improvements, but what really happens is people don't want to hire professionals, so they do all the work on their own. And now, of course, because of the existence of YouTube, you can pretty much learn to do anything you want to do in your home by watching YouTube, even some really obscure things. So I don't know if you guys know this, but I do some boat building as a hobby. And boat building is one of those things where there isn't a ton of ways to learn all of the different really weird things you need to do from boat building. So I've been thinking about doing a boat building channel as well, or a gardening one, but I don't know if I'll ever get around to that. So Home Depot, the world's largest home improvement retailer, reported sales of $38.9 billion for first quarter of fiscal year 2022. That's an increase of $1.4 billion or 3.8% from first quarter of fiscal year 2021. So 1 year improvement of 3.8%. That's pretty much in line with expectations. Comparable sales for first quarter of 2022 increased 2.2%, and comparable sales in the U.S. increased by 1.7%. Net earnings for first quarter of fiscal year 2022 were $4.2 billion or 4.09 per diluted share, compared with net earnings of $4.1 billion or 3.86 per diluted share in the same period of 2021. So that represents a 6% increase in diluted earnings per share. Honestly, for Home Depot, that's just about as good as you can expect, and that's reflection that consumer sentiment really hasn't changed all that much. If you look at Target's earnings too, consumer sentiment hasn't really changed that much in terms of how much they're spending. We may be looking with increased inflation, increased labor costs, that being passed on to the consumer. We eventually might start to see some demand destruction though. So we're not out of the woods here. I'm just saying that the guidance in the reports for these companies really isn't all that negative, right? It's really quite positive in a lot of ways. So the company raised its Home Depot actually raised its fiscal guidance and now expects total sales and comparable sales growth of approximately 3%, operating margin of approximately 15.4%, and net interest expense of approximately $1.6 billion, and a tax rate of approximately 24.6%. Diluted earnings per share growth to be in the mid-single digits, which is what you expect from Home Depot anyway, right? That's not hitting it out of the ballpark, but that's pretty good. Their earnings, though, not hitting it out of the ballpark, but pretty good. What you should expect from a large, mature company like this, right? I think that's actually really positive. Next quarter, when we see those earnings in July or so, I think that's going to tell us really which direction the economy is going in. Expect, though, we are still going to see inflation in food prices from the things that I pointed out earlier in the podcast here. So this is very interesting, though. Applied Materials. Do you guys know who Applied Materials is? Applied Materials is a company that provides a lot of machinery and infrastructure for chip makers, people that make semiconductors, and they're a good bellwether for technology in general. So Applied Materials, record quarterly revenue of $6.27 billion, up 21% year over year. There is absolutely no recession in those numbers. GAAP operating margin of 31.5% and non-GAAP operating margin of 31.7%, up 6.6 points and 2.7 points year over year, respectively. Once again, no recession there. GAAP earnings per share of $2 per share, non-GAAP earnings per share of $1.89, up 64% and 36% year over year, respectively. So, this is good. So on a GAAP basis, the company achieved a gross margin of 47.2%, operating income of 1.98 billion, or 31% of net sales, and the earnings per share of $2. I mean, this is absolutely amazing. So they say while the supply environment remains challenging, Applied Materials is doing everything they can to deliver for our customers, and we recorded our highest ever quarterly revenues. Our outlook for 2022 and beyond is very positive as long-term secular trends drive our markets structurally higher, and Applied's broad technology portfolio puts us in a great position to capture a larger portion of served markets. So look, in this case, virtually everything about Applied Materials earnings release was positive. There was nothing in it that was even remotely negative, right? But this may be reflective in the fact that just about everything that we use today in our lives has semiconductor chips in it, and that it may be a very long time before we see a real recession in semiconductors, no matter what the economy actually. I mean, barring the bottom dropping out of the economy, it may be a really long time before we see another semiconductor winter here. And I think this is the case here with NVIDIA. This is the case with AMD. This is the case with any other chip maker that's out there, Taiwan Semiconductor Company, and all of those, man. So those are some companies right now that have taken a beating, and I think it's unjustified. I think that particularly the semiconductor industry, if you have a stomach for volatility and you can take the ups and downs of being invested in a semiconductor maker, then this is a good opportunity for you. But let me tell you, I've been investing in semiconductor makers for a very, very long time, and the ride is very, very rough. All right. It's volatile. Oh, looks like I am in the flight path of helicopters again today. So not getting a ton of questions out there today. I'm happy to answer any questions you might have. Did want to remind you also that we do have super chat features on if you guys feel so inclined. And we see here, Jepson says, Belgium is here. You got this. All right. Thank you so much. So the articles that I pulled up today were just a few of the things that I kind of wanted to take a look at early on. So let me know if there's something that you would like discussed, and I'm happy to address that with you folks. So once again, I'm going to add here the bear. Let's look at the bear perspective here. The S&P 500 is near a bear market. History says it's not done falling. With the latest 4% drop on Wednesday, the S&P 500 is now down 18% below its all-time high and dangerously close to a bear market, defined by a 20% fall from its peak. Sorry, guys, drinking some coffee. I'm still just a little tired today. Where it goes from here is less clear. Of the 12 bear markets since World War II, 9 lost at least 25%. So statistically speaking, it is 3/4 of the time the market's going to lose at least 25%. 3 of the sell-offs were particularly bloody. 1973. All right, let's put 1973 in perspective. Right. So 1973 comes on the heels of what was already mild inflation. Plus, the U.S. was coming off the gold standard. Plus, the U.S. was being punished by OPEC for supporting Israel during the Yom Kippur War in 1973. 2000 was the dot-com crash. I think that's probably a bit more comparable to, in some ways, to what's going on. And 2007 is definitely a lot more comparable to what's going on. The bear markets began a steep and lasting decline of more than 40%. So the bear market in 2000 lasted 2000, 2001, 2022. The market was down 9.2%, 11%. I think it was 11.1, and then 22% in 2007. That's a very long bear market. And a lot of the folks that I know that were in the markets left markets permanently, right? Very interesting. Eric M says, weird how we're short on food when most of our food is fed to animals. So you're talking about corn for the most part, right? We grow a lot of maize that is actually not grown for human consumption. It probably could be eaten by humans. It's just not approved for it. So let's talk a little bit about that. So there's a few things beyond that. I was looking at this article in the Atlantic today about what's behind America's shocking baby formula shortage. And they break it down pretty simply. Like, I've known about this trade policy for a while with Canada. And to be honest, I didn't expect it to affect the baby formula industry. I thought it would affect the fitness industry more. But basically, bacteria, a virus, and trade policy are what caused the shortage in baby formula. It has nothing to do with the current conflict that's going on right now, and less to do with supply chain issues, more to do with a factory being shut down here. So, America's baby formula shortage has gone from a curious inconvenience to full-blown national crisis. Of course, this is being amplified by politics, right? And but let's talk about why this is. First, a bacteria. There were 2 recent deaths of infants from a rare infection, and the Food and Drug Administration investigated Abbott, the major producer of infant formula, and they discovered traces of a bacteria called Chronobacter sakazaki in a Michigan plant, and then they shut it down for a while. So, and as a result, the FDA recalled several brands of the formula, and parents were advised not to buy these. It was taken off the shelves, and the factory's been shut down for a while. Recalls are common, as this article notes, and thousands of drugs and products are recalled every year. They don't create a meltdown at pharmacies like CVS to instate Soviet-style rationing of essentials. Wow, that's really timely. The second cause, of course, is the pandemic. The pandemic snarled all sorts of supply chains, but this guy says that he can't think of a market that's yanked around more than infant formula. During the spring of 2020, formula sales skyrocketed as people stockpiled formula, just like they stockpiled toilet paper. And then as families worked through the stockpile, sales fell a lot. And this oscillation made planning of production extremely difficult. And it was complicated to get an idea of the actual market size. So it looks like companies sort of underestimated market size at this point, right? Demand for formula surged as parents hoarded in 22, and then demand fell. And then suppliers had no idea what to do through 2021. And now demand's rising again as they're working their way through those stockpiles, and they're not able to get them back up and running. So I was just reading an article on Abbott's factory as well. It's really going to take 2 weeks for them to open up and another 8 weeks for them to hit full production capacity. So we're looking at 10 weeks more of disruption in supplies of baby formula. So the third factor, and I think this is the most important one because this is going to affect us in the future when it comes to this, is America's regulatory and trade policy. And this note, while it doesn't sound as interesting as the bacteria and viruses, it might be the most important part of the story. The FDA regulation of formula is so stringent that most of the stuff that comes out of Europe is illegal to buy here, and due to technicalities like labeling requirements. But one study found that many European formulas meet the FDA nutritional guidelines, and in some ways are probably better than ours as well. But that's only one thing. Trade policy restricts the importation of formula that does meet the FDA requirements, and some that doesn't. At high volumes, the tax on formula imports could exceed 17%, which would make it very high. And under President Trump, U.S. entered into a new North American trade agreement, which is NAFTA Part 2, that actively discourages formula imports from our largest trading partner, Canada. And there's a way that they do that is not really mentioned in this article, and it's all about whey protein. So, and this is what I had to do a little bit further digging on this, because I don't like when the fact that they just throw someone under the bus like that without giving an explanation. And it was really all about whey protein. During the negotiation for NAFTA, Canada was basically accused of dumping whey protein on the market and disrupting the market. So they kind of limited exports of whey protein into, from Canada into other countries, right? So in that way, and that's one of the main proteins that they use for baby formula over the last couple of years, and that has really affected what's going on as well. So that article was in the Atlantic. You guys can look that up. So so how do you keep perspective in losing money on paper month after month? This is my first bear market. I don't need the money, so I'm invested, but it's painful to see my net worth cut by 20% or so. So Daniel, that's pretty interesting there, and I am very sympathetic with where you are right now, and I'm going to be honest with you, and it took me going through a few times to understand how losing money on paper is not really important, and you're going to probably recover all of your funds in the next couple of months, so long as you haven't made any absolutely terrible investments here. But look, it took me going through this 2 or 3 times, and not just with my own investments, but particularly like watching my client accounts and watch them jump through, flaming hoops to avoid a little bit of loss. and then missing out on the gains as the market went up. And then when we compared portfolios side by side on what they would have held by just buying and holding versus trying to time the market, getting in and getting out and timing it incorrectly. And sometimes I time, this is the weird thing. It created this perception that if you time one thing correctly and win big on it, then the rest of your losses don't matter, when that's not true. You need to be looking at total return of your portfolio, and the buy and hold folks consistently outperformed over time. And you can't think of yourself as, don't think of this as a sprint. It's a marathon. You're going from, especially if this is your first bear market, then I assume you're pretty young and you have a long investing future to wait in, right? Yeah. So there's a few things to keep in perspective there, but also the main thing is that I look at I look at these now as buying opportunities. This time around, I don't have as much money to buy in to a bear market, but the last couple of times we had a serious decline in the market, down 20 or 30%. I happened to be sitting on some cash and investing in there. And every single time I did, I invested and it drops another 10, 14% the friggin' next day. Right. But it doesn't matter. I know that a year from now, or 2 years from now, I'm going to be up a lot higher. Like the longest bear market we had was in 2000, 2002, and that lasted for about 600 days. The turnaround on that was pretty quick though. By 2005, if you hadn't jumped back in the market, which a lot of people didn't, I remember in 2007, I met people, and this is when I worked for a regional bank who had kept $100,000 in CDs for a couple of years. And I ended up talking to them, and they're like, I got burned in the last recession, but the market seems to have recovered. So I want to invest my money now. This is 2007. We're like 6-9 months away from total market meltdown, but that's how long it took for them to get comfortable investing again. So yeah, me here. So let me see. I'm about 65 in index, 25% blue chip, and 10% growth. Daniel, your experience being down 20% at this time in terms of net worth is actually right in line with expectations. If you're 100% stock, you're about 65% index, 25% blue chips, and 10% growth, which I assume is probably not just growth, but technology. If you're watching my channel, you probably got crushed in technology. You're down a little bit extra in blue chip, maybe around 20% or so, but your index funds are probably down around 15% or so. My overall portfolio right now is down about 12%, just because I have a lot of legacy positions in oil that supported that. I mean, I used to work for the oil industry, so I have a little bit more oil than most people do. And I've been slowly divesting myself of that over the last couple of years. But I got actually crushed in technology, but I've been investing in technology for a long time. It's always the most volatile portion of your portfolio. There's always the struggle when it comes to technology is, when do I take money off the table, right? When do I do that? I tend to have a 5 to 7 year time horizon as a minimum for my investments, but most of the time it's a buy and hold forever kind of deal. And that has burned me a couple of times in the past as well, where what is your exit point, right? There's a few things you may want to, and I wouldn't suggest that either you go out and buy or sell something just because you feel like you have to do something. The reality is you can't really do something in a lot of cases that is going to actually benefit you. You're going to do something that's going to be neutral or actually going to harm you in the long run. So let's talk about this. I read over and over and over that you can't time the market. In this case where the bottom is not clear, wouldn't it make some sense to start buying in and averaging down if needed? Absolutely. If you have the money to do it, you should be dollar cost averaging into some of the stocks that you thought were expensive just a few months ago. Upstart for me was one of those stocks that when it dropped to, like $150 a share, I was thinking, on a 10-year basis, this company's probably a pretty good investment, right? But I didn't have the money at the time to buy a nice round lot of 100 shares. But in this case, though, Craig, thank you so much for the super chat or the sticker. I'm not sure which one of those that is. But in this case, I would definitely start dollar cost averaging. So I ended up picking up like 10 shares of Upstart, and I ended up picking up a bunch of, not a bunch, but a little bit more SoFi. Ended up picking a little bit more Pubmatic when things were kind of at their bottom here. And if I had the money to buy more, I probably would have, but I've been wanting to keep some in reserve just in case things get a little bit worse, right? But yeah, now is definitely a good time to buy in and average down if needed. Also, if you are going to sell, one of the things that you might want to consider is the lot preference that you have with your brokerage company. You want to sell you want to sell the funds in which you have the lowest cost or the highest cost, depending on what you want to achieve with your tax strategy. Meaning that if you want to do tax loss harvesting, then you want to sell the lots that you have the lowest cost basis on and take the largest amount of loss, right? Wait 30 days before you buy back into that stock or even a substantially similar security. You can buy a substantially similar security that's not the same stock. I mean, if I sold 100 shares of Tesla, took a loss on it, and I bought 100 shares of Lucid, the IRS at the end of the year may actually disallow my loss in Tesla, saying that Lucid and Tesla are substantially similar stocks, right? So you want to be very careful that if you're going to do any sort of tax loss harvesting there, where you want to take advantage of that loss so you can write it off against other gains, then you want to make sure you do that in a stock that you think is going to remain relatively stable for the next 30 days, meaning it's down. You think it's going to be down for the next 30 days. And you think that, but you still want to own that stock, right? But make sure you're achieving what you want to achieve with your lots. Like when I sell options on Tesla stock, the account that I have where I sell call options, I have it set to sell the stock in which that I have the highest cost basis, right? So I'm generating $2,000 to $5,000 a month selling options on Tesla stock. And if I do have to sell Tesla stock, I'm selling the stock that has the highest cost basis. That way I'm not taxed on the stock where my tax basis is like $30 a share, right? Or actually it's like something like $6 a share now after the split, right? So, and that's literally my cost basis of my first 100 shares is now like $6 a share. So I don't want to sell those under any circumstances and pay taxes on it. So I have I'm doing lot specific sales. So yeah. So Eric M says, I just read a research report today that the USA's 3 biggest gas fields will enter terminal decline in the next few years, and that's 50% of total production. So yeah, so one of the things that I don't talk about so often, just because of where my audience is focused, is my knowledge of the oil and gas industry. And it actually goes fairly deep. That's kind of where I got my start professionally. That's where I made my first like real paycheck, where it was more than enough to buy ramen noodles or a 59-cent bean burrito at Taco Bell. And then when I worked as a programmer, and so I worked for the oil industry for a number of years, and I still keep up with it, and it's something I still research rather intently. So the U.S. actually does more drilling than the rest of the world combined. And I know that if you're paying attention to the news or to politics, you wouldn't necessarily think that. But I was just actually doing some research like 2 or 3 days ago, like industry research. And I think right now the U.S. has like 941 rigs active all over the United States and the world. So it's just U.S. companies either drilling in the United States or in the Gulf of Mexico or something like that. 941. So Canada has like 200 something rigs that are active, right? And they're like number 2. The rest of the world combined does not have more than 900 rigs, exploring for oil. So we are doing more drilling and more exploring than anywhere else in the country. We have, and during 2020 and 2021 and the first year of the Biden administration, the oil industry loaded up on permits, and most of these permits are still yet to be exploited. So it's not going to do anything right away for production, because it can take anywhere from 5 months to 5 years to get an oil field into production. Also, on oil or a gas field in production. Also, a lot of gas fields were capped and kind of permanently shut down during the pandemic. And a lot of people that I know, particularly that worked as either as roughnecks or worked in the gas industry, they went and found other jobs. And they do that frequently. The oil business is cyclical. Everyone I know that's been in the oil business for a long time, especially if they did the manual labor portion of it, you work, you earn a lot of money in a short period of time. The oil business is cyclical. The company you work for probably goes out of business. Management that moves on to a new company in a couple of years, and they call you back and hire you because they know you because you're part of the industry, right? So some of those workers were just older and retired after the pandemic happened. Some of them found more gainful employment, as we've seen wage inflation in a couple of areas. And excited, we're going to see an uncapping of a lot of wells that were shut down in 2020 and 2021. We're going to see new exploration. And yeah, so we have a ton of US gas fields that aren't even exploited yet. There's a great guy on TikTok. I can't remember his username right now, but he's an older guy. He's probably my age or a few years older. And he is a well renowned subject matter expert in the oil industry. And he will tear apart every argument that comes from any side of the aisle when it comes to the oil industry and tell you this is how it is. This is the data that supports the argument. Everything else is just political. Right. So, yeah, we have tons of gas fields that aren't even exploited here yet. And we have no idea what new technology is coming down the pike either. So, and that is a comment from Eric M. Eric M, you're a very frequent commenter on my live streams, and I really appreciate your contributions. You always have some really intelligent questions here. So, let's talk a little bit more about some of our favorite stocks right now. So, going to take a look at Xpeng. Right. Just pull up the basic Yahoo Finance information here for Xpeng. Xpeng had a day. They're up. They were below. I want to say they were below 20. Yeah, they were down to $18 a share here not too long ago. They're back up to $23 a share. I think my cost is somewhere right around $23 a share for Xpeng. So I was underwater a little bit earlier. I'm not underwater at this point. But yeah, so when we take a look at the earnings, remember this company has never had positive earnings. We've seen a really significant year-to-date drop down from $45 a share on January 4th down to $23 a share. I understand that a lot of people have kind of lost hope in this stock. But the big news here when it comes to the Chinese EV market is not Xpeng. It's not NIO. It's not even Tesla. It's actually BYD. BYD, when numbers are reported at the end of May, I am predicting that BYD is actually going to pass up Tesla in terms of how many vehicles are sold in China. Number one, BYD has a little bit more geographic distribution when it comes to their manufacturing facilities, and not all of their manufacturing facilities have been shut down, but they've been gaining market share from other companies for quite some time. And I think this is the month that BYD passes up Tesla in China as far as the best-selling vehicle. Their BYD Han is a great seller, but their smaller vehicles that are targeted towards like the taxi market are doing quite well. Yeah, and I've had a couple of people bring up Li Auto recently. And let's look at Li for a second here, where Li Auto is higher than NIO. It's higher than Xpeng at this point. And let me see what was Xpeng's market cap here. So Li Auto's 25. Yeah, so market cap for Xpeng is, let me see here. It doesn't have it on there. So market cap for Li Auto is right at about $25 billion. Earnings per share. They had one profitable quarter. But let's review what their strategy is here at this point. Their strategy is they have a single vehicle. It's not fully electric. And they don't have an all electric strategy at this point. And they basically have one factory that their own that's actually made under a production partnership agreement. It's not really clear exactly when they intend to have a second vehicle offering out there. They have been growing sales, but they're a leaner operation at this point, and their numbers look a little bit better. But it doesn't tell me how much they're investing for the future here, and that's what you want to see with a growth company. How much are you investing for the future? This company right here, we're looking at Fisker. Fisker is something I don't think I'd touch with a 10-foot pole at this point. I don't know how far away they are from producing a vehicle at volume, right? At volume. I don't know how far away they are at that. It's not clear that they have enough cash to make it beyond the next couple of years, the next year and a half of operation at this point. It's not clear that there would be any impact from, there would be any great interest in a secondary offering for Fisker either. They're just not showing any evidence that they're going to be able to produce a vehicle at volume. The company that I really like that I'm having issues with right now, and it's all about production volume issues, is Rivian. You have a very expensive car, a very expensive truck, $90,000 for a Rivian. They're not going to meet their production numbers. They do have a little bit more in the way of cash than I expected, but this is another company where I'm hesitant to invest in this company just because I like their product. That doesn't mean it's a great company. It really doesn't, right? Let me see here. Which Kathy Wood EV giant is the better buy? Interesting. I didn't even see this article. I don't know if you guys saw this or not. So let me see here. YB says, do you think that Beyond will be impacted by the wheat shortage from the war with Russia? That is something that I did not even consider. So I went to, I don't know where my wife went actually, but she picked up like a giant box of like Beyond Beef burgers and a giant box of like Beyond Beef, like the whatever the ground beef facsimile is. And I have to admit that I tried it years ago and did a video on it, and while I was like looking at the investment, and I thought it was pretty good. And I thought it's actually a reasonable replacement for a hamburger. You're not generally eating a hamburger for having the greatest quality meat. It's a matter of getting protein and fat in your mouth and enjoying it with some crunchy vegetables on top, usually some bacon too, and that sort of thing. And my issue with Beyond Meat is that it's actually a manufactured product, right? Yes, you're reliant on supply of certain things that are actually grown in an agricultural setting, but it's actually a manufactured product, which means it's subject to rights law, which means that the more you produce, the more efficient you're going to get at it, and the more that your margins are going to improve, right? So I think that if we see wheat shortage, remember wheat proteins are used in a lot of other things. Like wheat proteins are used in many other things. And flour is used in a lot of things, and we are going to see the price of a lot of those things increase. I don't know that we're actually going to see Beyond Meat be impacted by the wheat shortage. I don't know that. I know that the grain we feed most frequently to cattle here in the U.S. is actually corn. It's not going to be actual like wheat or barley or anything like that. Well, I mean, it could be. They'll feed them anything they'll eat, but it's probably not going to be that because the price is going to be so high. It's going to be corn. So not sure if they'll be directly impacted by wheat shortage from the war with Russia, but I actually expect that interest in volume of sales is going to increase for Beyond Meat and for Impossible Burgers and for a number of other imitators for years to come as the price starts to come down. Like right now, the price of beef is so high that fairly frequently it makes more sense for us to eat these Beyond Beef patties when we want to have a hamburger that does actually eat beef. And to be honest with you, if it's just a hamburger, I can't really tell the difference. And what else did I use it in? I use it in some. I'm trying to lose a little bit of weight right now. So if you guys have diabetes, which I do, just losing 10% of your body weight, which I did, has an enormous impact on your blood work, right? And I started eating a little bit of Beyond Meat to replace the beef, not because it's lower calorie, because it's not, because it actually has a better nutritional profile than eating just beef. It's just as high in protein, but it has a lot of other nutrients that are better for you than owning beef. And I'm not ever likely to become a vegetarian, but I understand the moral aspects of people who want to become vegetarians. And I think that if you are a meat eater who decides you want to become a vegetarian, that you might actually like Beyond Meat, and you might actually think it's a reasonable replacement or facsimile. And it gives you the same degree of satisfaction. And like I said, it is a manufactured product. The more they sell, the lower the price is going to be, right? Or the lower their manufacturing cost is going to be. So yeah, I think the future for Beyond Meat, if they can make it for the next couple of years until they sort of hit that S curve of adoption. Like right now, we're seeing this first wave in the S curve, and then we'll see adoption start to slow, and then we're probably going to see adoption start to reaccelerate here in the next couple of years. So, yeah, I do see a pretty bright future there. So, yeah. Anyway, I got to go a little bit early today, guys. It's been close to an hour. I need to make a call. I'm having a project done at one of my businesses, and I need to get a freaking haircut because I'm tired of using gel in my hair all the time. Thank you so much, Craig, for the $5 super chat today. I really appreciate it. It was the only one I got, and I am always happy to do this. I'm going to keep trying in this period of volatility. I'm going to keep trying to do once a day, hour long to hour and a half long broadcasts. But I'll probably be taking a little bit of a break from this in early June. I'm going to try and take a little vacation to decompress a little bit. Life's been a little bit stressful for me lately.
Well, I don't have a 9 to 5, which means my life is just a lot less stressful than many folks. I should probably be grateful for what I have. But anyway, thank you so much for tuning in today. I will see you folks next time. It's always a pleasure.